8%, 4.5%. These two numbers are having a fight. One of them is eating your money, the other is barely earning it. Most people don't know which is which. You're about to find out. Which number wins? That's the only question that matters when you're trying to decide whether to save or pay off debt. And there's a single equation that gives you the answer every time. Here's the problem. Your savings account is probably earning less than your debt is costing you. That means every pound you save instead of paying off debt is quietly losing you money. Around 68% of people with debt and savings have it backwards. They're building up their savings while paying interest on debt that's costing them twice as much. It feels responsible. It isn't. Every loan, every credit card, every overdraft has an interest rate. That's the percentage it costs you per year. Every savings account also has a rate. That's what the bank pays you to hold your money. Think of an interest rate like the price of money. When you borrow, you pay that price. When you save, the bank pays it to you. The question is, which price is bigger? Here's the equation. If your debt rate is higher than your savings rate, pay the debt first. That's it. That's the whole thing. Every other consideration comes after this one. Real numbers. If you owe £1,000 on a credit card at 22%, that debt is costing you around £220 every single year. Just sitting there. Just existing. Meanwhile, if you saved that same £1,000 in a cash ISA, you'd earn maybe £45 in a year. So you'd be £45 richer but still paying out £220. You're down £175 overall. Step 1. Find your debt rate. It'll be on any statement or in your banking app. Look for APR. That stands for annual percentage rate, or just the interest rate. Write it down. Step 2. Find your savings rate. Check your ISA, easy access account, or wherever your money sits. Banks are legally required to show this clearly. It's usually called AER, or interest rate. Now compare them. Is your debt rate higher? Pay it first. Every extra pound on that debt saves you that percentage, guaranteed. No savings account on the market can beat paying off a 20% credit card. One exception. Before you throw everything at debt, keep a small emergency fund, around 3 months of essential costs. Life happens. You don't want to clear your debt and then borrow again when your boiler breaks. Let's make it concrete. Credit card at 22%. Cash ISA at 4.5%. The maths isn't close. Paying that card off first is like getting a guaranteed 22% return. That's better than almost any investment on earth. The biggest mistake people make is treating saving and debt paying as two separate things. They're not. They're the same decision. Every pound has one best job. The rates tell you what that job is. Don't save while carrying expensive debt. It feels like you're doing two good things at once. You're not. You're earning 4% on the right hand while paying 22% on the left. The maths always wins. One number beats everything. Your debt rate versus your savings rate. Compare them. The bigger number tells you where your money belongs. Simple, clear, repeatable. Every time your situation changes. Today's action. Open your banking app right now. Find the interest rate on your most expensive debt. Write it down. That number is your benchmark. Everything you do with your money gets measured against it.